So let's get started with today's seminar. Good morning, everyone, and welcome to this quarter's SEPREF seminar, which is focused on ESG. As most of you already know, SEPREF is an organization within Samhällsbyggarna, and SEPREF was created for those of us who work with or have a strong interest in research and analysis. We at SEPREF strive to increase transparency and to spread and share knowledge within the industry with our quarterly events, such as this one. I want to thank everyone who is joining today in this virtual seminar. And I will now hand it over to Christina Gustafsson, my fellow steering group member, who will moderate the seminar. Christina?
Thank you, Tiffany and Karin, for giving me the opportunity to share this webinar about the topic ESG and commercial real estate investments. The program you could see here, it starts with 3 experts giving their views on trends regarding ESG and the real estate industry from different perspectives. A panel discussion will follow in the end, and it all ends at 10:20 at latest. The format for this is a webinar, which means you could see us, but we can't see you, and you hopefully also can hear us. The communication we will use is the Q&A function in the bottom. You could see that in the bottom on your screen, and you could, whenever you like, write your comments or questions during these sessions, and I, together with support from Tiffany, will check these, and we could pick them up in the concluding discussion. And as you noticed, we are this seminar will be held in English, but you may write questions in Swedish if you like. So now I would like to move on to the presentation and welcome the first speaker this morning. It's Damian Harrington. He's Director, Head of Research, EMEA Global Capital Markets at Colliers. Colliers is a global full-service property consultant firm, same as Karin comes from as well. You work together, I expect. Damian is based in London and will, from this point of view, give us the international perspective on this topic and how does ESG compare across continents, markets, and various parties. Please share with us your views about ESG essentials, Damian.
Okay, good morning, everybody, and thanks for the kind introduction, Christina. Let me just share my screen. So, right. Can you see that properly?
Should be the
full screen.
Another format.
That it?
Yeah, correct.
Yeah?
Thank you.
Okay, right, great. So look, quick scene setting in terms of what I'm going to cover. I'm just going to touch briefly on, the evolution of guidance and frameworks and structures and where we are today and how that differs globally and what we're seeing from an investor perspective in terms of where their focus is internationally with regards to ESG. I'll then look in more detail at European policy in action, look at what different investors are doing and how they're reacting to certainly some of the newer policy. And then I'll just touch on some of the key energy and social aspect factors around real estate that are driving change and will, continue to drive change and make this a pretty complex and complicated landscape to navigate. And again, I'll just touch on what Colliers is trying to do in this field. So first one is, building blocks. Lots of acronyms, lots and lots and lots of acronyms around how to set a policy or set your company or your investments on the right path to meet sustainable development goals. So for the last 20-25 years, maybe even longer, the others have set out goals. We more recently had the sort of Paris Agreement to bring down energy usage and reduce emissions and hit better targets. In and alongside that, there's been lots of other systems to help companies disclose what they're doing, frameworks to understand and measure how they do it. It is a very complicated landscape. Which benchmarks do you choose? Which company do you choose to do this? At a kind of fund or a corporate level? And then on the top here, how do you actually manage and assess a building in terms of, is it measured correctly to get to the standards that you want to get to? How does that fit with your governance? What's the overall aim of what you're trying to achieve? It's a really, really complex set of different frameworks and information that's driving this whole thing. But I think in the last couple of years in particular in Europe, it's becoming a bit clearer through EU taxonomy, the introduction of the sustainable finance development regulations, and actually that should be CSRD, the corporate sustainable reporting directive, which is now starting to make it clear in terms of what we need to do as companies in Europe to get towards these goals. I think in the US, the Securities and Exchange Commission is also making moves to try to standardize and regulate how this is going to be managed, but it's primarily about guidance and disclosure to avoid greenwashing, rather than having any real set specific targets as to how to improve the energy efficiency of assets, as it were. So, it is a minefield, and having spent a lot of last year trying to understand it, I'm still not sure I fully understand it, and I'm not sure whether anybody else does. But there we go. So I think when we look at it from an investment perspective, we put out our global investor survey reports. The next one will be out in just over a month, hopefully. And we asked last year, to what extent is ESG a part of your investment strategy? 75% yes. What does that mean? Well, it clearly differs by region. And even though we say, does your ESG strategy alter by region? Most said no. But what's absolutely clear is where their focus is by region. So if you look at the bar charts at the bottom, there's a very strong focus on getting this right in EMEA. And I do believe that's down to the policy changes, which are becoming more forthright and more open. Compared to the Americas, it's weakest. There are bigger challenges there, certainly in the US, in terms of how this is evolving. And certainly what I hear is certain states are saying, we don't want ESG. It's almost as blunt as that, whereas some states in the US are more for it. In APAC, it's somewhere in between. And I think when you look at countries like Australia and Singapore, it's now very much part of national legislation to do something quite clearly about this. And certainly when we come to the certification side, schemes like Neighbours, which help certify buildings, have probably been doing, it's probably the best system out there globally in terms of actually measuring energy efficiency and emissions compared to any other certification system. So it's a bit of a mix, but the focus is clearly very strong in Europe. So if we dial back a bit before we get into the latest sort of governance or guidance or policies, for a long time, the narrative in Europe has been like 40% of our emissions come from the built environment, 80% of the building stock is still likely to be in place. So we need to retrofit and renovate it to bring it up to standard. Now, at the minute, or up until the last couple of years, that the rate of building renovation in the EU is about 1.2%, 1.4% of stock renovated per annum. To hit target, that needs to double. So it just gives an indication of how much more retrofitting needs to happen of the existing stock if we're going to hit our energy and emissions targets by between 2030 and 2050, ideally by about 2040. But I think what's also interesting in the last couple of years is the narrative is slightly changed, or maybe it's just my reading of it. So it's not just about getting to net zero, because I think that's practically impossible, but nearly zero. Yeah. So it's making more of an effort to reduce or improve the efficiency of the buildings to get towards that target, because hitting that target purely is just, I don't think it's practically possible. And one of the real challenges with that is what the cost of hitting net zero would be. Now, look, this is a broad estimate, and I appreciate that it is, but we just wanted to look at this in at a high level last year. If you looked at all real estate across, or the built environment across Europe, we had to do some estimates here in terms of the size of the stock, but we looked at it by sector across major kind of commercial centers and cities to get an estimate of what the square meterage of stock was. We then, based on EPC ratings that we could find in markets, started to build an estimate of how many buildings are EPC A versus B versus C, D, E, and F. So A and B are obviously the much more energy and emissions efficient buildings. And then what's the cost of actually retrofitting those buildings to get it to net zero, and what's that total cost? So the total cost over 20 years could be something like 5 to 7 trillion. That's a big number. To put that number into context, that's equivalent to the annual level of investment volumes that the European market sees every year. Yeah. So rather than spending money on buying buildings, the money's going to go into retrofitting buildings. But what's also clear from this, the low cost portion here is quite small. So that reflects a limited amount of capital expenditure that's needed on your kind of A and B rated buildings to bring them to scratch, but you clearly need more on your D, E, and F. Whether that's right or not, or whether that change will depend on technology, construction skills and technology to make things a bit easier to do. And I think what's interesting in the last year, talking to some investors, and what we're seeing from some of the listed sector, is that they're not spending as much as a percentage of capex to get towards this target, which pushes towards the nearly target. And we're talking about 1% or 2% of capital value, rather than maybe 25% or even more. But having spoken to some investors in the past 12 months, and even picking up notes from the likes of CBRE Investment Management, the figure for capex could be 25 to 30% to retrofit everything. So there's a balance in terms of what it's actually going to cost, but it will cost the industry, which is an opportunity for many. And then, of course, we've got the new policy and directives. So SFDR is now in action, and I think every investment company in Europe needs to have kind of adhered or looked at that in terms of what it means for them and how they market themselves, how they market their portfolios and their assets, and what the classification of those assets is. Then on the corporate side, it's about the CSRD, which is more about corporate level assessment of their company and its goals and what they're doing towards that. So you've got the investor side and the occupier side. I think roughly, if you look between the two, the investor side, everything is more focused around the energy, the E aspects. The occupier side is actually more focused around the S. It's around diversity and inclusion and other social factors. So there's a combination of factors, and these two things also have to join the dots, as it were. So one needs to talk to the other, and certainly what a company is doing when it's occupying real estate, they need to provide more information back to the landlord so they understand what they're doing in terms of how they're occupying space and how that affects them. So it's it's still very much a work in motion. I think it's going to take a while for the whole thing to settle down and to become clear in terms of what it means and who is where on that journey. And then, of course, you got the EU taxonomy classification system on top, which is there to try and help simplify it. Is it simplifying it? I think in time it will, but right now it's quite challenging in terms of just getting the language right and understanding what everything means. So if we take a snapshot of that, our Dutch team did a study in May that they published in May or June, which looked at investor alignment to SFDR at that point in time. So there are three kind of articles which investors need to kind of adhere to, and I'm sure most of the audience already understand this. So excuse me if I'm teaching grandma to suck eggs, as it were, but you have Article 6, Article 8, and Article 9. Article 6 is limited levels of sustainability that are going to be in action within your assets and your portfolio. Article 8, light green, is that there are certain aspects of your portfolio or your assets that is promoting sustainability, whether it's the E or the S factors. Article 9 is everything is very focused on sustainability. Yeah, so it's a very ESG compliant and focused portfolio or set of assets. But I think when you look at the investor preference, it's pretty clear as to where they want to be. Most are in the light green space. They're doing something about it, but they're not purely oriented towards that. There's still quite a few that are in the gray, 40%. The expectation is that that will change over the year as things become clearer in terms of how they adhere to these regulations and guidance. So that would drop to 20%. Article 8 will go up to about 73, but only about 7% of investors in the Netherlands, and the Netherlands has been behind this change for a good 20 years, certainly its pension funds. Only 7% are saying that they want to go pure green. Part of it is down to, it's just the regulations themselves are very ambiguous and nobody fully understands what they mean or what the implications are. They don't want to overclassify themselves and then get their knuckles wrapped for greenwashing because they're not actually doing what they think they're doing. And also all of the additional reporting requirements that come with it are very complex and time consuming, and they want to avoid that. And just to give an indication of some of the ambiguity that was coming through, it's, if the taxonomy alignment pushes to get towards EPCA rated buildings, how does that work if you're an investor looking to buy an asset? You're going to retrofit it, and then you're going to either retain it or sell it. And there was real ambiguity as to whether, okay, if I buy something for 50, I spend 50 million retrofitting it, is the whole value of the asset taxonomy aligned, or is it just what I'm retrofitting? And the belief at the time was that it's just the retrofitting element, which just tells you how ambiguous it really is and how difficult that makes it making decisions as to what your strategy is going forward. So a lot of investors saying, well, look, we just want to buy existing clean assets or stick with that, even though a lot of putting capital to the side to be able to fix those assets and compensate for the additional costs of fixing them on acquisition, but not to sell. So it's a really kind of opaque picture. We look in the UK as to what's happening. And the UK, of course, is not subject to EU laws anymore or EU taxonomy. But I think when you look at the listed sector and the sector generally, there is a push towards ESG, more sustainable, more energy and emission efficient assets. We look at two big players here. I think interestingly, I was touching on earlier, I think both of these companies are aligned to EPRA guidance, which is the European listed sector guidance on ESG, but their focus is on retrofitting. Obviously, they have huge portfolios, so they're focused on retrofitting that. Their energy targets differ from company to company. So British Land wants to get and again, how it's reported looks different. They're looking at a 25% improvement in energy efficiency. Landsec is just looking at a 45% reduction in its energy usage to 2030. Both are talking about electrifying the assets. British Land talks particularly about using more renewable energy, which I think is interesting, and we'll come on to that shortly. But there's clearly a shift also towards operating carbon reduction is a big focus. 75% reduction for British Land, which is quite significant, 45% reduction by Landsec. But also they want to cut their embodied or embedded carbon target. And that also brings into play another factor that is just convolutes this whole thing. So I'm pretty sure everybody understands the difference between embodied carbon and operational carbon. Embodied carbon is the carbon that's used in the production or the creation and construction of the asset. Operational carbon is the energy and emissions generated just from the use of the asset. So most of the focus at the minute is on operational carbon. But when you look at planning systems across Europe and certainly in the UK now, when you apply for planning to build a new building or do something with the building, you have to set out the whole life carbon plan. So that is the embodied carbon element and the operational carbon element. So it's coming into play in terms of anything new that's coming to market or any retrofit that's coming to market. You have to have a full plan for both of these things, not just the operational side. Is there a benefit in terms of trying to build an asset that is very good in terms of its embodied carbon? At the minute, the belief is that construction cost for a more energy and emissions efficient asset is about 6.2% higher than traditional construction. The concern is that that construction cost may go up relative to other forms of construction. The plus side is it's certainly, you know, I think one of the challenges is there's very limited evidence today, or that I've seen, which genuinely looks at energy rated assets and what the premium is. In London, EPC A-rated rents have typically traded at about 9% higher to lower grade, you know, standard good quality office stock. So there is a premium in those rents to offset that construction cost. And of course, there's many other benefits in terms of lower operating costs, reduced void lengths, they're more liquid assets, and certainly in this big shift towards quality, that's quite clear. But I guess the question is, at what point will that possibly change as more and more of these quality assets come on stream? Will that premium still be there, or will it just become the benchmark rent? When we look at operational carbon, you know, the target that's coming through a lot of case studies is to try to cut the standard energy use for a good quality office building is around 220 kilowatts per hour per meter squared per year. The target is to try to drop that to 70. So it's quite a big drop. And there are various things that you can do to try to make that reduction, to get that reduction down to 70 kilowatts. You know, I think if you use more air conditioning in a building, it's up to 240 kilowatts. So this is just a UK example, but it does tell you that in different parts of Europe where you have different climates, you know, you've also got to adopt this model as to how it's going to work. But essentially, the key things to change here are tenant and tenant education, optimizing your BMS system, and replacing the heating and cooling. Now, there are some examples that even through occupier change programs and management, and just educating an occupier and a manager how to operate a building, can actually save up to 50% of your operational carbon before you actually go into any fixed costs. Everything else is going to cost more time and money, but the more efficient floor plates, LED, and certainly the cooler side, there are examples now that this kind of work is projects that we're working on now. It's happening now, so it's difficult to have full examples of what it's actually going to cost and how long it's going to take, but the phasing of work is up to 7 years. For new chillers that are much more efficient, you know, there is a 7 to 10 year payback on those. At least that's what's estimated based on the energy cost savings that can be made. So you're looking at a strong payback, but it's going to take 7 years for a lot of these projects to fully retrofit. And given the scale of everything that needs to be retrofitted, it just tells you how much pressure there is on the industry in terms of materials, labor, and skills to enable this to happen. The other element, of course, is, you know, the energy that we use in our countries and in our buildings differs markedly across Europe. And I think everybody's fully aware of stranding, how stranding works. And when you look at the CREM system to get down to the 1.5 degrees, it will give you a different line for different countries, which reflects the quality of the energy that that country produces, which is based on its energy sources. It also reflects, or should reflect, that there are different targets in different countries to bring down or to optimize energy use and emissions. So up in the Nordics, where you guys are, you know, you're ahead of the curve in many respects, and your targets are to come in much sooner than everywhere else. The UK and the Netherlands have more specific targets around the built environment, where so in the Netherlands, it's already the case that only A and B rated buildings can actually be leased or sold, and that's now in effect. It comes into the UK next year. It's slightly more lenient on the target, but the idea is that there's more of a push to target the D and E buildings once you get beyond A, B, and C. But so there's specific things happening in those countries that are much more targeted to real estate. But I think also when you look at, you know, how enshrined in law are these emission targets or energy targets, not every country in the UK has enshrined these targets in law. There's an awful lot which don't have this black line around them that have not got there. And there are some, you know, clearly when you get out of the EU and into the Balkans, their net zero target date is unknown, or for some it's 2050. If you look at the next slide, there's a bit of a correlation there in some of those markets in terms of this source of energy. Now, I know this is a little bit complex, but the three colored bars represent composition of energy in the grid. So the green is what's green, yeah, Grey is nuclear. The dark part is hydrocarbons. So that's gas, coal, oil, or a mixture of those things. So the Nordic markets are like the best markets. They're up there on the left. You move to the right, you've got quite a few Central and Eastern European markets in here, which are much more dependent on hydrocarbons. You've also got the Netherlands and Italy in here, and Germany's not far off. And in fact, the UK is not that far off. So even though at a European level, we'll probably hit the renewable energy directive of getting up to 33% of energy to be renewable, I think there needs much more of a push, certainly in some countries, to get towards that target. But as mentioned earlier, they have not enshrined those targets in law. So for countries like Poland, they're a long way off. Plus, the hydrocarbons that they use tends to be quite dirty coal. And in some respects, when you look at the stranding, Poland's got one of the most severe stranding curves over the next 15 years to get towards this target. And I also know, not just Poland, but other countries globally, certain investors are now starting to discount countries as a location because of this. Yeah. They're saying we're not going to invest in that country because there's no plan or clear target to reduce or improve how energy is generated. Now, renewable energy has gone up. This one's very complex, but we'll share it afterwards. But I think the positive thing is if you looked at energy composition from, say, 5 years ago, we're in a much better place, which shows that we can move in that direction. So solar energy is up almost 70%. Wind is up 70%. Unfortunately, and this is also the interesting one, hydro is actually down by about 14%. So it also tells us that whilst we can embrace the climate to create more renewable energy, the climate itself is also changing so much that some of our renewable energy created, certainly via hydro, is actually dropping because we have droughts and we have less snowmelt. So it just complicates the entire picture in terms of how this is going to work. Plus the seasonality of all these three sources differs. So you should be able to mix them up to create a more sustainable energy supply. But it also implies, and I think we all know this, that the storage of this energy needs to significantly improve if it's really going to have a positive impact on how we change the planet. And then finally, what does this all cost and what does it mean for an investor looking at this? So when we looked at this at the beginning of the year, we looked at, right, what's your current net operating yield on a prime office asset in different markets in Europe? So let's just assume that, okay, you have a more energy efficient building, you're going to get a rental premium. So you go from this yellow dot and your yield goes up because you're getting a higher rent for a better quality asset. But then what's the cost of creating that asset? Is it 5% of capex or is it 25% of capex to actually get to that standard? And obviously that cost is going to have a negative impact on your yield. The more you have to spend, the more negative it is. And I think one of the challenging things for the market at the minute is we're in a clear price discovery mode in terms of what's happening with interest rates and inflation and when that's going to settle down and when and where yields will ultimately settle down. So whilst ESG is still a clear part of the agenda, I think one thing we're working on is how much energy costs have increased in the last 6 months since we first used those figures, and it's clearly high. So there's clearly going to be a bigger benefit in terms of reducing the operating costs and capitalizing that. The picture is mixed in terms of, is it worth embarking on such a strong level of capex? And certainly given what's happening to pricing and capital values anyway. And then finally, that's the E. The S is also becoming increasingly relevant. I think WELL, which assesses the kind of environmental quality for staff and buildings, essentially, their business model has just boomed on the back of COVID because it's now so clearly important to get that right in buildings, and that has to be factored into the cost. And then, of course, you've got the impact investment side of, what's happening with affordability, to a degree, deprivation, and where are the opportunities for investors around that. Clearly, affordable housing is going to be one of them, and that's a global thing. And I think when you look at the percentage of households that are 60% below the median income level, it tells you how big that market could be. But it also has an impact on assets and valuing and measuring assets relative to their sort of broader socio-economic value. And that's one of the things in Colliers that we're starting to do through this social value questionnaire. And again, that's one of the many things that we put into the system called the Hive, which enables any landlord to be able to assess their portfolio across a wide range of metrics relative to what their focus is, what guidance they use to be able to try to improve what they have. But as I said earlier, it is very complex, very difficult to manage. I think the targets that are there need to be more realistic, and they're ever changing. Energy risk, and I'm sure the guys are going to talk about this a bit later, is clearly accelerating the push towards this, but climate risk in itself is also changing how renewable energy might work going forwards. And the whole impact on pricing and values is probably going to take another 18 months to really figure itself out. That's it from me.
Thank you, Damian. It was a great introduction to this topic about ESG, and you also covered all the challenges for the industry in adapting the regulation and the cost for adapting buildings is enormous. A short question only. It seems to me like Sweden is lagging some main countries like the Netherlands and UK in how you are using EPCs and giving them a very prominent role in formation of national regulation. With tough targets, C+ on existing stock. It's like new building standards for existing stock by a few years ahead, and it will force owners also to do this because you can't let buildings if
you legally can't let or sell a building that isn't up to standards.
Not sell either.
Yeah.
Okay.
Well, if you can't lease it, it's going to be even more difficult to sell it as well.
Obsolescence. Yeah, it will be obsolete.
Yeah. So it's going to really drive obsolescence. Yeah.
Yes. So what about your listed buildings? You have a lot of historical buildings.
Yeah, I mean, that's where it gets complex, right? So the rules around listed and around how you apply EPC that's a good question. There are conditions or kind of leniency towards those types of buildings. But again, I know the EU is trying to standardize EPC ratings per se, which again is just another one of those challenges that it has to try to do to make this a level playing field. But you're always going to get those nuances around listed buildings that make it more complex.
Yeah. Thank you, Damian, and I hope to see you again in the concluding panel discussion. And I've also heard that we've seen here in the Q&A that your slides seems to be very interesting to get. And so thank you. Next speaker to follow is Louis Landeman. He has a long experience from the financial sector, and he's also well-known face in our research community, famous for his podcast, Kreditvärlden, about corporate bonds, the credit market and financing, and you are also an author of a book about corporate bonds. Louis is head of credit analysis at Danske Bank Markets, and he's based in Sweden, in Stockholm. Louis will focus on ESG risks in the Swedish real estate companies' active lending via issuing corporate bonds. Please, Louis, share with us your rank of ESG risks.
Thanks a lot. Thanks for the kind introduction. And thanks, Damian, for an interesting presentation. Not the least, it was interesting to see how inefficient in terms of energy your offices are in the UK. I was just surprised by that data, but that's an interesting thing to discuss. But I think that was actually a brilliant presentation and gave a lot of the overview. I think what I will present is kind of more of a case study, how we could look when looking at these risks here in Sweden. And just to explain sort of my role and how I come into this is that, so I'm an analyst focusing on the corporate bond market and heading a team of credit research analysts here in Sweden. and we're part of the Danske Bank Credit Research overall team, where we make risk analysis, credit risk analysis of companies we cover, companies and banks. And in that role, we have been thinking a lot about how to integrate ESG risks in our fundamental company analysis. And we do want to have an integrated approach. We do not think we can do it on the side. It needs to be included in the normal analysis. So what we have also discovered while doing this is we think we have improved the quality of our analysis by making a broader, looking at broader number of factors, certain things that are not priced in today, but could be priced in tomorrow, which then constitute a risk. And for each company and each sector that we look at, we define what are the material ESG risks that we need to consider, because the materiality will depend on the sector and company and so on. So I'll just try to give you an idea of how we have approached this, and then look at the Swedish real estate as an example. And here, the first slide that I'm sharing is sort of how we established our approach. We did it a few years back, and now we have this ESG risk coverage on roughly half of our ongoing coverage, and the ambition is to get to 100%, but we do it step by step because we think we need to do a deep dive into each industry to fully understand, and I think it needs to be done by the specific analyst being a sector and company expert to understand how it fits into business model, etc. So what we basically do is we combine a top-down approach with a bottom-up approach, and the top-down is sort of very similar to what Damian showed, that you sort of look at the industry and see, okay, how does the CO2 footprint look like? How is the energy consumption? And when you understand that from a macro perspective, you then do the bottom-up analysis to see, okay, if we have defined that these are the risks, what is reported by the company, and then you would probably see that some of these risks are well reported and some may not be reported. And then for the factors not being reported, we try to establish alternative means to assess the risk. And I can show you how we have done in this particular real estate example. So then we do this going through the E and the S and the G, and then we set the sub-scoring on each of these, and then we set the scoring for the whole ESG risk. And that's kind of an overall assessment. And then we think about it in a relative context, thinking how could it impact credit spreads on the specific company that we are looking at relative to what is being priced in. So it's not an absolute scoring, and it's not a formal scoring either. It's more to show how we have, where we see the main risks and how it fit into the overall company analysis. And then we also look at the reporting and have a separate scoring on that. So that's the general idea, but to be more specific, looking into the Swedish real estate, taking that as an example. So starting with this top-down approach. So you can start by looking at emissions, and then we use data from the Swedish National Board of Housing. And this is one example, and I think this gives broadly the same picture that Damian was painting. And what you actually see quite immediately is on the bottom left on this slide is the CO2 emissions. They actually come almost 50% in Sweden from imported goods and services in the sector. And what does this mean? Well, it means that the production process, as Damian said, has huge impact, and that's like probably half of in the life cycle of the total emissions. So immediately by looking at this, you realize we have to look at how can this be changed, not only looking at the existing buildings. And then we also immediately understand that most companies are very good of reporting their CO2 footprints related to the existing buildings, but not that many in terms of the production process. And hence, that's something that we have focused a lot on to understand better. And then you will see as a percentage of total emissions in Sweden, so it's 50% of greenhouse gas emissions, but it's 34% of energy consumption. We have a pretty good mix of energy in Sweden, but nonetheless, the sector also need to work on energy efficiency. So that would be another main topic. So this would be one part of the top-down analysis, but there are more than just the emissions if you think about climate risks. Just to mention a couple of examples, if you look on the following slide, this relates to the direct physical risks of where the buildings are located. And then you could look at this type of long-term scenario analysis in terms of increased sea levels of water, flooding. And what you will see, and this is kind of the first part of the analysis, is to understand that if you have coastal erosion and flooding, then there will be certain areas in southern Sweden impacted. But when you look at the flooding risk in terms of extreme weather, you have the map to the right, you will see that many of the big cities in Sweden are actually exposed. So what you need to do here is, as a second step, is to go in on the micro level to see exactly where, for a specific company, will the buildings be located, and of course, what mitigating actions are being taken in that particular city. And to give just a flavor, this is something that will cost a lot of money, given that we expect more extreme weather. And you could think that this cost will be sort of taken by the municipalities, and that's true. But I think, given how much money it will cost, we should also expect that the private landlords have to pay part of this. So that's also something to be sort of further investigated, so to say. And that's also a finding when you look at this, that we need to have a good dialogue with the companies about what they're doing. So that's kind of a few of these material, let's say, environmental risks and climate-related risks that we see. What we then do to test the materiality is to sort of investigate and stress test some of the key ratios we look at when we analyze these companies, like financial ratios, credit metrics. And so what we did here, and actually looking back to this now, it's turned out that we thought it was a tough stress test where we doubled the cost of energy, but it turned out now that the cost of energy is much higher than what we had assumed here in the stress test. But what it shows is basically that if in this particular case, we doubled the cost of energy, and basically you would see that they would have a material impact on the leverage for most of the companies on the coverage. But so that, again, this is a starting point, and then we understand, okay, this is a material factor, so we need to dig further into this. But what then becomes a bit tricky is that in many cases these costs are sort of then rolled over to the tenants. So it may be that the companies are much less exposed than what you think by looking at this, but then it actually depends on type of properties, type of rental contract to have. So residential contracts, perhaps, that you actually in Sweden carry the cost of heating, while for offices is carried by the tenant. So again, it leads to a better dialogue with the companies to understand this, and also to understand what figures they're actually reporting. But it turns out that there isn't one single standard, and I guess that's another pretty big topic actually in terms of the reporting, how you can make it more standardized and so on. So in this particular case, we saw, this has a material impact. We need to look further into this. When we looked at the direct CO2 emissions related to the existing buildings, you can see on this slide that actually when we stress tested the CO2 emission cost, putting a cost on it, could be debated, of course, what amount you should put on this cost. But anyway, it generally seems that many companies do not have that much emissions, given that we have a fairly favorable energy mix in Sweden. So this cost is not that significant, actually. So that's other finding. But then coming back to the construction process, we also actually realize that those emissions are quite significant and would be material. And the problem then that's not reported. So how can we sort of assess that? Well, this goes back. I think this is actually not from the latest annual report, I should say that. But when we did this report, we looked at project development as percentage of total property portfolio market to do a proxy for how much exposure you have or how much new buildings you are actually constructing. Then you should actually add the renovations to this, because you use material for renovations as well. But to get one type of proxy, you can then see, we have some companies here with fairly big project development portfolios, and in fact fairly many companies have, at that stage at least, had quite large property development. So then you understand that they do have fairly large CO2 emissions. So we do need to definitely look further into this, and also how can you alter the business models, given that this is not very easy to replace concrete or whatever you have, where you have the emissions from material, for example. So that's on the E side. We could talk much more about this and all the other risks. So these are more a few examples. But again, as Damian said, let's not forget about the social risk. I stated here often neglected, but it does increase in importance given that societies cannot handle all of these costs by themselves. There is a lack of affordable housing. You also have problems in Sweden in terms of certain areas where you need to improve integration, how to improve whatever you call it, socio-economic balance, so to say. And this could be done in different ways. But I guess the interesting thing with the increased popularity of social bonds is I actually think that social bonds could be something that we will see more companies in the sector issuing to finance certain projects that the companies then would define that would have certain socioeconomic benefits. It could be constructing a new building with a fairly low rent or affordable rent that would make more people having jobs moving into a certain area where you have unemployment, high unemployment, as an example. There could be, of course, many other projects. So I think this is actually a pretty good opportunity for the sector and quite interesting. We have many companies in Sweden doing green bonds, but not that many so far doing social bonds. So that's could be something to look for. But now we talk about these risks, E, S, and G. We should also look very briefly on the G risk, and this is looks like a semiconductor scheme or something like that. I don't know what you call it, but a pretty complex scheme. But it actually shows the cross ownership that you have in the Swedish real estate sector, and transparency and governance is, of course, very important topics for us. So this is also something that we have flagged as this is a risk that this companies that the sector has, given that throughout the years you have increased the cross ownership situation. I think now it's more challenging financing conditions, and we will see how this plays out. But actually, in some cases, this governance issues have moved to center stage, so to say. If you look more closely into this, you will actually see that it's not cross ownership between all companies. It's more like different spheres. So I think what may happen now, if someone is weaker, that may be picked up by someone stronger, etc. So it will be extremely interesting to see how this plays out, whether we will see a more, let's say, clean structure over time, or how this will be developed. But for sure, this will change quite a lot, I think. But again, so governance, transparency, financial policy, very important for us, and we would tie that into our credit risk assessment, having the view that, for example, we are not the shareholders, we're interested in a sound balance sheet. So a huge buyback scheme, for example, would be for us perceived as negative, while on the equity side, for example, that could be positive. So you have to always remember who you are doing this analysis. We are one counterparty to the companies, and then there are many other counterparties, and depending on who is looking at the company, of course, you may come to different conclusion, just to make that clear. So that's that. So final point is just that we do look at the reporting, and then look again, getting back to this thing with energy intensity and comparing to what Damian was showing, was interested with the 220. So we have here energy consumption and energy intensity per respective companies, and you see that they actually all, well, you have one that is about 200, but apart from that, they are more towards 100 or below. These type of numbers, of course, increase in importance when looking at EU taxonomy that focus a lot on this and the energy certification of the buildings. But for us, again, this is just one part of the bigger picture. And in my view, of course, we will also look at the EU taxonomy and alignment and so on, but I also would see that as a developing target, given that it doesn't capture the full picture. And I think you do need to start by looking at the full picture, and then you can look at these various sub components, but you always need to keep this big picture center stage, and then you can otherwise you may end up with the wrong conclusion, saying that let's build an extremely energy efficient building, but you spend a lot of concrete doing it, and perhaps as a life cycle analysis would tell you that's actually not the right thing to do. And then of course long-term targets, are they science-based or not, and so on. For us important and interesting is that many companies are moving clearly in the direction of having science-based targets, and most in Sweden now have targets, which was not the case a few years back. So I think things are progressing quite quickly in the good direction. And then to sum up, then we summarize all these things into our own assessment. We don't need to spend so much time on that, but the main conclusion is that we have, I guess, like a medium ESG risk for most companies here, with a few exceptions. And yeah, that's all. And I guess there will be more time for questions later. So, but in the interest of time, I will stop here.
Thank you, Louis. A short question only for you. I noticed that none of the companies analyzed have been rated high risk or has been considered to have poor reporting. Is this sample a better half of the industry?
Well, okay, it's a very good question. So it's also like in relation to what's being priced in by the market, and just to explain how we have scored the reporting, so you don't think it's too good. It starts with average, and then you have good, and then you have excellent. So actually the average is like the
bad,
worst, so to say. Yeah.
Yeah, okay. Thank you.
Which may be a bit confusing. We haven't set like poor or something.
No, poor. No.
That
okay.
sounds a bit negative.
Okay.
So average. So it's average would be a few, and then good, and then even better than that. And then, so no, we don't have high risk. Again, it's a relative play in a way. But as a matter of fact, if you look at CO2, for example, the starting point is not that bad in a way, considering the energy mix we have in Sweden. And then the interesting question now, I guess you could debate, given how much spreads have widened in our market, if we would do this assessment now, perhaps we would have even fewer with medium to high, given that spreads are super wide. So you can argue that a lot of these risks are being priced in, given that companies are priced as being much lower rated credits than what they are currently, for not for these reasons, but for other reasons. So it's yeah, I don't know, there is no right or wrong here, but that's how we done it anyway.
Thank you, Louis. Last but not least speaker is Jakob Lindberg. Jakob is ESG and climate specialist. He works with client coverage and in EMEA at MSCI. He has a master in environmental economics and management from Ultuna in Uppsala, and he's based here in Stockholm. Jakob will give us a overview of MSCI ESG research for investors. Please share with us how you and MSCI analyze ESG risks and how the investors can benefit from this analysis. Jakob.
So as Christina said, I will give you an overview of MSCI's ESG research, focusing on investor and the use for MSCI's ESG researching tools. So first of all, I just want to give you an overview of MSCI as an organization. Many of you know MSCI from the index business, perhaps, where we provide benchmarks to investors. So how they can actually make sure that their investments or funds track a certain index. And where I sit in this leg called ESG and climate, that's the newest part of MSCI, but it's also included in all of the 4 pillars that you can see here. So except from indices and ESG and climate, we also do analytics. It's actually risk management systems. And the 4th pillar here, private real assets, that's mainly our real estate business. I'm sure you heard of, for example, Svensk Fastighetsindex and other type of real estate solutions that we provide. As I mentioned, ESG is part of all of these 4 pillars now, and the main driver for that is that investors have become less tolerant of ESG related incidents, and they want to capture this and also to get the best returns possible. So the solutions that we provide from the ESG and climate perspective is a set of tools that we use for analyzing companies. So if we look at the gray pillar here, ESG integration, that's our flagship solution with ESG ratings. The rating goes from AAA to CCC. And it's not like the rating that Damian talked about on properties. This is a rating we do on company level. So assessing the ESG related risks and opportunities in sectors, and then giving or allocating a rating to the company on how well they're dealing with those risks and opportunities. We also do this on fund level so that investors can get the aggregated rating on their funds based on the underlying holdings within the fund. And as you might have seen, there have been some criticism against ESG ratings lately. I think Elon Musk was upset that Tesla didn't have a higher ESG rating, but it shouldn't be viewed as a tool to measure environmental impact. We have another solution for that. This is simply to measure how the company is dealing with the ESG related risks and opportunities, as I mentioned. So you can be a company in a high risk sector, but still receive a high rating. I will get more into this in a few minutes. Then looking at the blue pillar, that's something that our client base is very interested in now, especially the past few years. So our typical clients are investors, so banks, pension funds, asset managers, and all types of asset owners. And in order to measure the climate impact of their investments, we have tools to track on company level emissions, carbon emissions, also targets that the company sets in order to reach certain reductions or to be aligned with the Paris Agreement, for example. But we also look at green opportunities, so companies involved in any solution that can benefit them in the long run. So if you have, let's say that you have a change in policy that will limit the amount of carbon emissions in the future, then if you're a company that have tailored solutions for that, then you will come out as a winner. And if you're a high emitter, then you will of course be a loser in that sense. So also something that's recently launched is tools to measure physical risk. So Louis was also mentioning this in his previous presentation. So we map the most material physical risks for companies based on their location. So if you have an asset, a coastal asset, for example, then the risk, if we reach a 3-degree global warming, for example, then the risk that your asset will be worth 0 is higher because you might have flooding, etc. But we look at 10 different physical risks, so extreme heat, extreme cold, flooding, etc. And we also have to look at the transitional risk, because that's also part of what happens to the society and the market value of the companies you invest in if you have change in policy that forces you to change your operations, basically. So that's something that's a tool that many investors are interested in nowadays. And if we look in the middle here in the picture, that's something that's been around for a long time. So companies' involvement in certain operations, that's something maybe that you want to track or exclude from your investments. So we do business involvement screening, mapping companies that are involved in alcohol, tobacco, weapon, for example. And then the investors can set certain thresholds on how much revenue they want their investments to allow, for example, in the portfolios. Here's also global norms and controversy. So if you want to make sure that the portfolio companies follow the global norms, such as UN Global Compact, for example, we monitor the market, more than 10,500 companies globally, following our MSCI flagship index. It's called All Country World Index. And with subsidiaries, the number of issuers is a lot higher, actually. And for the controversies, I will also get into that in a minute, but that's where we monitor companies on if they're involved in an ESG related controversy. We have a red light system, so we can flag them red, orange, yellow, and green based on the severity of the incident. So then investors can take decision based on that if they want to make changes to the portfolio or not, basically. Then the yellow pillar here, impact investing. That's what I mentioned in the beginning. So companies that are doing good, we can look at the revenue from companies related to sustainable impact. And it's not just environmental impact, it's also social impact. So could be companies deriving revenue from renewable energy, energy efficiency, but also affordable real estate, for example. And then you can take bets on the companies that you think you want to keep in your portfolio, for example, based on the sustainable impact they're making. So this is the tool that Elon Musk should have looked at when he had some comments on the ESG rating, basically. And here also comes the SDG alignment, because some investors might want to align their investments with the 17 UN Sustainable Development Goals. And then we'll look at what revenue streams do they have for different segments that's fitting to the 7 SDGs. So if you want to focus on number 13, climate action, for example, then you can see what companies are involved in that. And then the fifth pillar around regulation, that's the newest addition to the data set. So as both Damian and Louis mentioned, there are new regulations in the EU, SFDR and EU taxonomy, and investors need to report on their portfolios and issuers in their portfolios on how well they're actually aligned with these. So for SFDR, we source data on the principal adverse impact indicators, the PI indicators, and then we have this sort of toolbox. So it's not that you can be compliant with the regulation just to get that data set. You still need to do the reporting yourself, but this is the tool you need in order to potentially be compliant. So moving on to more taking a step back, why ESG now and why investors are interested in looking at these metrics. So previously, if you look 10 years back or even further, the climate and ESG investing has grown dramatically. And that's because investors have become less tolerant of issuers' ESG incidents. They're also showing willingness to act. And the understanding of the ESG influence on return and risk has become increased over the years. And also the data and the ESG ratings, for example, has been enhanced so that you can actually look at the correlation between these nowadays. So here's a map of a few examples, companies that had been involved in an ESG-related incident, and that had a huge impact on the company's market, the share price, the stock price, actually. So if you look at Volkswagen in 2015, that's when they cheated with the emissions, so the Dieselgate scandal. Prior to this, MSCI actually rated their company CCC, which is the worst degree or rating we have. And reason for that was issues with governance. So in our ESG ratings, we'll look at E, S, and G, and based on that, we make our assessment. So what we want to show here is that if an investor look at ESG ratings and take those into consideration in their portfolio construction, you could potentially avoid investing in a company like Volkswagen in 2015, and then get the best return possible if you only stick to the highest rated companies. And it's not automatically that a AAA rated company wouldn't be involved in an ESG related incident, but the risk that it would happen is much lower than for a CCC rated company. And climate change is also something that we have seen that it's a key risk for institutional investors to look at, and it's not just the part of the risk associated with climate change, but also the opportunities. So if you look here at the green box in the middle from Massachusetts, you can see that since 2005, the local real estate market has collectively lost more than $250 million due to coastal property value from flooding and sea level rise. So that is something you need to take into consideration when investing long term and short term for that case. And if you look at the red dots, in India, the government plans to have every car sold from 2030 to be electric. So that's a huge opportunity for car manufacturers who wants to increase their sales in EVs, electrical vehicles. So this you will find opportunities and risks that you want to take into consideration. And if you zoom out a bit and look at the institutional investors that have been wanting to act on this, we can see that since 8 or 10 years ago, we have seen large pension funds and other institutions wanting to switch from a market cap index to an ESG or climate tilted index, meaning that they will track their investments based on ESG preference or climate preferences. Could be excluding the worst emitters, but also finding the best and highest rated companies. And this is, of course, driving a change in the market and how where other investors will follow. If you see the huge demand in environmental and social friendly companies. And there is actually a correlation between this. So we have done research showing that if you stick to the highest rated companies, you could also get higher profitability. So there is a correlation between these. And we have one of our indices, MSCI KLD 400 Social. It's the earliest ESG index we had. It's going back more than 30 years. And if we look at how that index have performed compared to its parent index, MSCI USA, you can actually see that it has outperformed its parent index. With that, we want to show that it's actually ESG and good return are something that should come hand in hand and not the other way around. That has been discussed, that if you want to look at ESG, you would have to lower your returns, which is not the case. So quickly, just on how investors have been looking at this lately. First of all, or in the beginning, we can say that investors started to separate their investments from their values. So exclusions, they would simply not invest in companies that doesn't follow their values. So excluding coal and alcohol, weapons, etc. Then the focus were more on impact. So actually investing in those companies you feel would make an impact or contribute to the transition to a more carbon neutral world. And what we've seen lately is that you want to integrate ESG in all your investments. So you want to include the ESG criteria in order to also maximize your financial returns. So we have seen a change in behavior from the investors, you can say. So here's an example of the ESG rating methodology. And as Louis mentioned as well, that they were looking at different materiality based on industries and sectors. That's what we do as well. So we have a ESG rating score and a letter rating, which is then separated into E, S, and G pillar scores. Those derive from 10 different themes, which in turn are also separated into 37 different key issues that we look at. And depending on the sector or industry that a company will rate are in, we choose between 2 and 6 different key issues that we will focus on. So in this case, from the real estate and management service industry, we're focusing on green building, human capital development, and the 2 governance themes. And here we actually look at all governance key issues. So in this case, it could be real estate companies such as Colliers. We will look at the most relevant parameters when we rate the company. And if this would have been another company in another sector, for example, Coca-Cola, then we would have looked at maybe packaging, material and waste, product carbon footprint, for example, so that you choose the most relevant industry risks when you rate the company. And that's also making the possibility for you to compare them with each other. So as I mentioned, to derive a letter rating that comes from an industry adjusted score. So when we rate the company as Prologis, we compare them to the peers. And if all companies within that sector get a score between 0 and 10 at, let's say, 2, then we will weigh that score to the peers so that you will still have the best in class and worst in class. You can't just have all companies very poorly rated. There could be a distribution that looks separate from other industries, but we will have a weighing. And as I mentioned, this comes from a score in E, S, and G. So you can find the companies best performing in S or E or G. And that's actually something we see a lot of investors demanding. They are not just interested in the letter rating, they're interested in the data below, the raw data and key issue scores so that they can make their own assessments and also to find the companies that they are interested in. So to be cautious of time, I think I'll stop there. Thanks a lot.
Thank you, Jakob. It's very interesting, really. I wonder if you also analyze risks in connecting to Russian activities in other countries.
We do have a geopolitical assessment. So we do, of course, do government ratings. So a country as an issuer can get a rating. And Russia now tend to have the lowest rating, of course. But I think what you're after is if we look at sensitive territories or occupied territories, for example, and we also look at global sanctions. So if you have a company involved in any business with in relation to Russia or any sanctions, that's something we can collect and get the information on as well.
Thank you, Jakob, for your presentation and your sharing your exclusive insights about ESG trends and challenges. And thank you all speakers for that. But now I invite all 3 speakers again to join in the panel discussion. To kick off with one question is ESG. Which one should have the highest weight for different type of investors investing in different sectors like offices, residential? Is it any difference between funds? Could you start, Damian? Do you have any
Thank you.
view on that?
I mean, I think you've got to get the G right, because if you don't have governance over what you're doing, then everything else is not going to work or be joined up. So I think you have to get your governance structure set out so it's completely joined up, irrespective of what sector you're engaged or involved in, because that may well change over time. But I think after that, clearly with what's happening at the minute with energy risk and climate, I think the focus is naturally going to be on E, and then thereafter it's on S. But again, as we mentioned, Lou's mentioned it, we'll all mention it, but the social aspect in terms of deprivation or the proportion of households that are close to, quite frankly, the poverty line tells you that there's got to be a greater focus on that. But that's economic as much as what directors can do or investors can do directly through impact investing or investing in affordable housing, for example. And by affordable, it doesn't have to be, what's often kind of phrased as social rented. It can be what's private rented, but is just genuinely more affordable. And I do know of certain investors that have set and established funds to target that as a market.
Louis, do you have a weighting on your 3 letters?
No, but I actually think that kind of question is sort of impossible to answer in a way, because if you think about it and talking about doing like a broader risk assessment, you can't, I mean, if you think of a corporation living in an environment, so do you need a sustainable climate? Yes. Can we do without that? No. Okay. We need a functioning society? Can we do without that? No, you cannot. So it's just different layers in sort of the broader picture, so to say. Then you could say for a specific company, one specific risk may be higher or lower. depending again on this materiality. But I think it's sort of to say you can just focus on the E and skip the S and the G, or I don't think that really works actually.
And Jakob, what does MSCI think about the weighting of the ESG?
Yeah, that's a good question. So we do, of course, look at the weighing of these three components, and across industries, we see that the G is always the one around a third of the weighting, so 30%, whereas E and S can derive a bit depending on which industry. So you can have E as low as 5% weighting of the total score, whereas the G part is always around at least 30 or higher. So I think that to echo what Damian said, G is as a ground component in order to have a good company and how it works. But then, of course, E and S is depending on the industry, I would say. So yeah, we take that into consideration.
Okay, thank you. I saw another study from a Swedish bank who they reported that the weighting for residential companies focusing on residential should be more on S, like 30% on S, but for companies investing in commercial property, only 10% on S, and that's a huge difference, of course. But let's, do we have any questions from the audience, Tiffany?
No questions. Please come in with your questions. So there aren't any questions.
I mean, I can just add one thing, which I think how everything is tied into, in a way, the normal analysis, again, coming back to what we see currently related to the sector and how it's assessed in capital markets. There is a lot of focus on these governance issues. So if you had, let's say, going back a few years, if you had considered this more, then you could have pinpointed some of these problems very early on. So yeah, I guess it shows, like, if you do your broader analysis correctly, you may be ahead of the curve, I think.
And EU taxonomy favors and focus on the E a lot, on energy and environmental, and focus on financing new buildings, like Damian told us, and not the existing. So Louis, please tell us, would you finance the obsolete acquisition of an obsolete building, or only the renovation of it? Because the taxonomy would say it's not a green.
Yeah, again,
investment.
It's coming back to this point that I would be careful saying, well, of course you could, you can see a risk that if people just follow the taxonomy and nothing else, you may end up taking some very strange decisions. Because I think with the problem with the taxonomy is also that it's sort of, it has an ambition to, okay, we're going to do a social taxonomy, we're going to do this and that will evolve. So the whole taxonomy will evolve, it will become broader. And then you may start to alter some of the things that you have now set. So you set, certain standards, and then you realize actually some of these standards are set just because they don't have enough data. So I think if you look at the real estate sector, the starting point was that, okay, EU understands that we should have a life cycle approach, but we don't have a data that captures a life cycle approach. So we cannot measure that. So let us start with doing a benchmarking and on energy certificates. That's what we can do. And perhaps that's a reasonable approach. My point is just that I think you need to see the fuller picture and try to capture the fuller impact. And then I think you can have a business case, or you will not have a business case on a certain renovation project, and that could potentially be financed. And I hope that not all financial institutions will just say, no, we cannot finance this because it's not taxonomy aligned. But yeah, there is a risk of that happening if you focus just too much on this. measurements.
Just to second that, I think that the taxonomy alignment itself clearly needs to evolve to just be more rounded. It is not at the minute. I think the problem I was trying to set out is just so ambiguous in many respects. People don't know whether to do one thing or another. And I think when you look at the kind of the article alignment, it's clear that the bulk are going towards the middle ground because they don't want to go too far out and say they're doing one thing when in fact they find out that they haven't been able to get to that point in terms of being truly sustainable. And I think with SFDR in itself, when they set out the regulations, you know, they caused a huge flux in the industry, but also because they hadn't actually set out the measurement standards or the benchmarks by which you classify assets and how you did it. And that came later, and I think that came out in April, May, and it's a huge document. And given everything that's been going on in the world in the last 6 months, I haven't had time to read a 150-page technical document on how to measure assets. And I think the other problem is only the big firms can. So they're the ones that have got the teams and the staffing and the resources to do it. When you get to your kind of mid-cap or smaller investors, they've got maybe one person trying to do this. And it's a very, very difficult, challenging task.
Okay, Tiffany, we had a comment.
Yeah, that kind of brings us to a question that has come up from the audience. That ESG has come a long way in the office segment. Are there other segments that are lagging behind, such as the retail segment or maybe the light industrial logistics segment?
I think if you look at companies like Segro, they've made a lot of advancements in terms of how they adopt renewable energy into their projects and sites. So I think like industrial and logistics is moving at a relatively quick pace. Again, there's a kind of disconnect in terms of how this can actually work and how you can set up renewable energy facilities on site or within a park. And sometimes it has to be divorced from the assets itself, but I don't want to get into the weeds of that. I mean, I think the focus is on offices because offices tend to be very energy hungry.
Is retail being left behind then, or?
But it could also be, I mean, offices and like thinking about what the requirements have been or demands from the tenants. If you have in the office segment, perhaps larger international corporations, they may have very ambitious ESG standards, and then they would demand a certain energy certification on basically on their lease, and then so you can sort of, getting back to what Damian said previously, you can charge more to rent out that particular property. So I think you have perhaps had larger incentives in that segment, but I think other segments are now starting to catch up, and again now with the higher energy prices, that is kind of pushing everyone in this direction. So my guess is that we will probably see increased focus on this also in the sectors that have been previously lagging.
So it's time to conclude this session. I only want to say that I hope that these questions like about ESG won't lose attention and speed now when the recession is approaching. Hopefully. Many thanks to your excellent speaker or all of our excellent speakers, and to Samhällsbyggarna for organizing this webinar operationally. And is it anything more we want to say about the future, Tiffany?
Yes, thank you everyone, and thank you, Christina, for moderating this session. The next SEPREF event will be during the first quarter, and it will be our annual event looking at the trends going into the next year within the real estate industry. So keep your eyes out for an invitation to that event, and thank you again for participating today.
Okay, thank you.
Thank you.
Bye-bye.
Thank you.
Thank you.
Bye.